All right, guys. So, sorry, it looks like I got some hydrocortisone in my mustache, dude. Um, Hydrocortisone, I guess. I had to put it right here on my nose. My nose is weird, but yeah, what's up, guys? Today we have the FOMC rate hike decision, and market's looking really good today, man. Market is actually pumping up today. SPY hit 437. Starting to turn back a little bit here, but still pretty big green day hit. Went as high as almost 440s today, which is just a crazy big increase. What's up, Stacy K, Rippin, Antonio, Mo? All right, guys. Yeah, it's time for the FOMC rate hike decision. Honestly, I'm really curious to see what we're gonna get today. Genuinely curious to see what we're gonna get today. Sorry, let me get this hydrocortisone out of my beard. Bearish? Honestly, I don't know, man. The market ripped up pretty big today. So the market ripped up pretty big. Nike beasting today. Yeah, honestly, the whole market is pretty strong. In all honesty, it's a huge week this week, man. We had PPI this morning, CPI today, and yeah, I'm curious to see what we're gonna get again. I don't know. Ryan all the way up to 420s today. Was that above the previous high of the day or previous high? Yeah, so 422.70s is the new high, man, for Nvidia, the new lifetime high. So Nvidia broke lifetime highs. Coca-Cola. Yeah, we'll do a poll. Does the market react positively or negatively to today's FOMC decision and press conference? Positive reaction, negative reaction, and for reaction. All right, so we went ahead and did that. Again, Nvidia at 418.60 is just powering up. And so far, we got a surge of votes just now. What's up, Wyatt? Negative reaction. I don't know. The argument I think for a negative reaction is that the market's already pushed up. Like, here's the Q on the left here. Like that has already pushed up drastically over the last 20 days with the AI craziness. You know what I mean? So like that's the argument for like a bearish reaction. I think a large majority of the market expect a pause today. So skip or whatever you want to call it is highly probable at 97.7%, basically 98%. 98% think we're going to pause or skip. Only 2% think we're going to raise rates. So definitely an interesting day today. And yeah. So yeah, we got this type KO dropping it a little bit, but we rode that one up really nicely for our swing trade as well. Is the music too loud? Let me see. It's not that bad. I'll lower it a little bit. There you go. And yeah, we'll see what we get. Hard to believe Nvidia can maintain over $1 trillion market cap. It's silicone and plastic. Yeah, but couldn't the same be said about any technology? A computer's just metal, and plastic and rubber, It's not worth anything. I mean, again, I think Nvidia chips are useful, So, hey, what's up, Shepard? What does pausing do to the US dollar? Well, pausing is generally good for the markets and bad for the dollar, usually. But sometimes the market can be unpredictable. And so I really don't know in that regard what we're going to do today. Really don't know. What's up, Shepard? Neutral might mean a drop a bit and trap a few bears and scare a few bulls, then goes. Yeah, maybe. What's up, Shepard? Hope your day's going great. Yeah, it's going okay. Busy the last few days, but it's all good. We're also going to do a Twitter post here. All right, so today the FOMC announces their decision. Does this affect the market in a positive way? Yes or no? All right, so we got a Twitter poll as well. Nvidia is still holding strong here, still pushing up some. When is the FOMC rate hikes out? So 2 p.m. Eastern Standard Time. So in about 51 minutes, they're going to announce their rate hike decision. I hope they pause and things go well for the next month so they drop rates. Hey, what's up, Architect? Bank of England still raising rates up to 6%. Hey, what's up, Git? Again, the SPY is now down to 437.70s. The Q still ripping up. Q is just very strong here. I think we got to look at like Nvidia too to see what the root cause of the market pushing up. I mean, PPI did come out lower than expected today, and that is inflationary data. So we did have lower price announcements today. And again, I don't know what we're going to get today. I hope we get positive stuff. What's up, Will? Isn't it quad witching week? Is it quad witching? So quad witching is the third Friday of the month, where all 4 major contract types expire same day. So it'd be stock index futures, index futures, stock futures, index options, stock options, and they all expire same day. It's historically known as a big day of volatility. I don't know if today is quad witching or not. I feel like I would have heard about it, but maybe not, man. I might just be out the loop. I did just get back from vacation last week, so I might be out the loop in that regard. I don't know, but it is quad witching. Is it really? It's at Beginner Trades is my Twitter handle. What's up, Traum? Can Bitcoin go down or up if the market is positive? Usually Bitcoin is going to have a positive correlation with the market as a whole, except for a couple specific sectors. One of them is banking. So generally weakness in banking causes strength in crypto. I think the other one might be precious metals, like gold and Bitcoin sometimes move in a positive correlation with each other, but I might not be completely correct about that. I think generally, though, crypto follows the market. Okay, so on the 16th of Friday. I heard no longer quad witching is triple witching. So Monday, the market is closed, so that's good. It is the third Friday. I just looked that up. Yeah, so the 16th would be the third Friday. It might be quad witching. I don't know. I don't know how you pronounce it. I'll just pronounce it conventionally as witch. Bro, prediction on Bitcoin. I really have no idea what Bitcoin's gonna do, bro. No idea, man. I hope it goes up. It's at 26K. It's been a tough week for crypto though, with the SEC being crazy. So I really don't know what Bitcoin's gonna do. I hope it goes up though. All right, so we got 71% of people think that the FOMC affects the market in a positive way. 29% think it negatively affects the market. Looking at our YouTube poll here, we got about 200 votes already. 58% think a positive reaction, 23% think a negative reaction, 18% think neutrally. There, and again, vote on that poll. Help support the channel. We appreciate it. I'll probably be trading the E-mini, the NASDAQ, the SPY. Sometimes it depends. Yeah, I mean, a pause is highly likely. It's like 98% likely. Yeah, what's going to matter more, though, a pause is pretty expected already. So, like, it's highly probable that we do a pause. What's going to matter more so than that, like, we can, at this point, the market's already baked in a pause, right? So that means a couple things. The first thing is that if we do not pause, the market will have a brash reaction and the market will freak out, and we'll probably get big drops. If we do pause, we just got to look at it in a neutral fashion. And so in that regard, I don't know what the market's going to do if we do pause. What's going to matter more so, as long as we come through as expected, which is a pause or skip or whatever you want to call it, what's going to matter more so than anything, if we do skip or pause this cycle, is what Big Papa, Jerome Powell, says during the actual press conference. That's what's going to matter more than anything else. We're going to cover it. We're going to stream it all. We're going to cover all of this stuff live right here. So again, subscribe if you haven't yet. We're going to go over all this stuff. We're going to stream the full press event. You'll be able to watch what the decision is, and we'll announce it as soon as it happens, and then we'll stream the full Jerome Powell press conference. For that reason, that's why we get thousands of people here, because they know this is a reliable place to watch it. And again, the Q pull it back a little bit. We're at 264.50s here on the Q, 264.50. So tech, you can see the SPY starting to fall back down here a little bit. It's at 437.50s here, 437.50s. And again, we'll see what happens in that regard. I don't know. 50 basis points would be chaotic, dude. 50 basis points would be bad. It's not going to be positive. It's not going to be good. The whole market's going to freak out. But it's just so outside like probabilities that it's not really something we should worry about. Again, it's highly probable we're going to pause or skip, and we're not going to raise rates at all today. He does love it when you call him Big Papa. That's true. J Powell pumps SPY by just breathing on the mic. Sometimes he can destroy the market. I know one thing. He's probably going to say, we're going with 2%, and we think we have what we do to hit those targets. That's what he's going to say, almost certainly. He will also probably say inflation is still elevated, because that's just kind of how it goes. Inflation isn't a concern for me as a person anymore. Yeah, I mean, gas is cheaper. Again, inflation has gotten noticeably better. People can say it hasn't, but gas, for instance, a year ago when inflation was rampant, much worse than it is now, gas was like $5 something a gallon, $6 a gallon. Now in my area, it's like $2.95. It's like $2.80s. So gas is noticeably cheaper at this point in time, and that's good. What are some keywords to look out for? Raising rates more than anticipated, raising rates higher than anticipated, recession, those things. If he says we're likely to hit a recession this year, the market will probably immediately have a negative reaction. He'll probably, if he talks about how bad inflation is, the market will have a negative reaction. Probably if he says, again, the probabilities of a recession, if he says they're going to raise rates and be more hawkish, those are all things that could cause the market to drop. And again, if you don't know what hawkish means a contracting monetary policy. It means they're aggressive in their rate hikes. And the whole point is to restrict spending, push down spending by, raising the federal funds rate, by making banks make less money. And when banks make less money, what do? They charge you higher interest rates. When they charge you higher interest rates, what happens? People stop buying stuff as much. When people stop buying stuff as much, what happens? Businesses lower prices. So it's a big cycle of trying to curb inflation through rate hikes, but that's the point of it. That's what happens. And again, I don't know what we're going to do. I think it's very probable that we're going to pause today. I think that's very probable. I think we'll skip the recession. I think it's a lot more likely now that we're going to skip it this cycle versus last cycle. Last cycle, everybody was still kind of nervous and worried. But this cycle, the market's been flying, mostly propped up by AI stocks, but still, I mean, Walmart's been going up. It's green on the year. So I need a coffee or something. Oh, dude, my stomach is just wacky right now, man. I'm trying everything I can to get my stomach to settle down, but Bitcoin just broke down under 26K. Hey, what's up, Pawn? Hope you're doing good, bro. Hey, but thank you for becoming a member, Wyatt. I appreciate you, brother. Yeah, thank you, dude. I appreciate it. Shout out to you, man. The time of the meeting is 2:30, so it's going to be in about an hour and 15 minutes. The meeting postponed to 1:30 New York time. 1:30 New York time is not when the meeting is. That would make 1:30 New York time would be earlier than the meeting typically starts. So again, I'll explain the procedure here. The FOMC meeting usually starts at 2:30 New York time. And so 1:30 would not be postponing it. That would be starting it an hour early, which would be at about 12 minutes. That's not what it is. The reality of it is that the FOMC rate hike decision will happen at 2 p.m. Eastern time. So at 2 p.m. Eastern time, they're going to announce how much they're going to raise rates, if they're going to raise rates. Again, it'll most likely be a skip or a pause. And then at 2:30 is when the accompanying press conference happens, 2:30 Eastern Standard Time. So if I'm in Texas, so it's 1:30 my time. Cinnamon vitamins. Yeah. Here, let me see if Carol will help me out real quick. Hey, you're on stream for a second, and I'm unmuted, so don't curse, really. Can you make me a green tea and also bring me a water, please? All right, thank you, baby. All right, love you, bye. All right. Sorry, Carol's gonna bring me a green tea. I forgot to do it. I already started the stream. I don't want to walk off for like 10 minutes and have everybody be like, "What the heck?" Again, Jimmy, what's your source? Jimmy, what's your source on that, on the meeting? Surely I should be able to Google that and see the same thing, correct? Yeah, I don't see anybody say at the meeting. The meeting's going to be at 2:30, almost certainly. 2:30 Eastern time. That's just when it's going to be. Again, vote on our Twitter poll as well. We got a Twitter poll going. So far, Twitter is saying about 64%. All right, so yeah, the FOMC meeting is still going to be at 2:30 today Eastern Standard Time. I just checked it. The SPY started to break down. It's at 437s. Yeah, I mean, Carol and I, we curse sometimes. I curse like a sailor when I'm off stream. You might not realize it because I'm pretty family friendly on stream, but I don't know. We'll see a hawkish Powell today, and the markets won't care. Show me recession and earnings. Maybe. I don't know. We'll see. Where to find where they are. There are. So they're going to speak right here. We're going to stream it all live. Can you give us your opinion on today's Fed decision? The Fed will raise rate, or the Fed will pause. I'm sorry. The Fed will most likely pause or skip or just not raise rates. So when you check it, it's going to say from 5 to 5.25 most likely, which means they pause or skip. Technically, that's a neutral reaction that's most likely already baked into the market. Now, if it was a surprise skip, that would probably cause a bullish response, a bullish reaction. But because the market's been ripping up basically every day now, it's been really easy to make money on the long side lately. That shows me that it's probably getting baked into a potential skip or pause. If you look at the FOMC Fed CME watch tool, 98% of people think we're going to skip or pause today. Only about 2% of people think we're going to raise rates. And so what that means is generally those things are correct. And so the probability of a pause today is 98%. 98%. Now, again, there's still 2% chance. This morning it was 7%. So it's actually changed even more polarized since then. So the discrepancy has increased even more, but again, 2% of people think we are going to raise rates today. Only 2%. The rest of the market. Thank you. Huh?
Who's this? Which one do you want? There's Jasmine.
Give me the Jasmine.
You haven't tried this one.
Yeah, but Jasmine's, I don't know. A lot of the time the matcha ones have sugar in them, and so I don't really want sugary tea.
No.
I don't know. This will work. Thank you, baby. Love you. Thank you. Anyways. Sorry, let me make my tea here. But yeah, what if he hikes again? Oh, the market will absolutely not like that. If he raises rates as a surprise, if for whatever reason the 2% is correct here. So if for whatever reason the 2% is right, the market is going to unload to the downside. It's going to free fall. Most likely. Again, you never know. Nothing's 100%. You realize that pretty quickly. Watching the market, you never know the response. Sometimes CPI comes in low, the market crashes. Sometimes PPI comes in low, the market crashes. Sometimes CPI comes in higher than expected and the market goes up, and vice versa. So you really don't know. But if for whatever reason we do hit that 2% unlikely scenario where we do raise rates today, the market will not like it, I think. Again, just speculating, but I'm pretty sure the market's not going to like that. Generally, the way it works is like aggressive rate hikes cause short-term pain to equities and other markets as well. So if everybody's expecting us not to have that short-term pain, not to have that rate hike, and then we surprisingly show it, then again, the market's probably going to fall. Most likely. Again, you never know, but again, let me know what you guys think in chat. I don't know. Gas here is like $2.80 a gallon carbon in Texas, bro. Again, I don't know about Arizona, but yeah. Saw something very interesting about low PPI and CPI was due to one metric, which was gas. Gas definitely went down, but gas is a major purchase, so it depends on how you look at it. Growing up in Louisiana is in your DNA to curse because mosquito. Yeah, I just think my friends curse growing up, and so I curse too. And then it's a very hard habit to kick as you get older. I think there's worse things than cursing, you know. What I tell my daughter is like, hey, poop and the SH word are the same thing. You know, there's no real difference there. The only people acting like there's a huge difference are, you know, they're just being a little too stuck up about it, I think. But yeah. Again, Nvidia bouncing at the 200 EMA. It's at 418s right now, so Nvidia is popping at the 200 EMA. I hope the market crashes. This up market for no reason is ridiculous. It's not for no reason, you know. Some dude telling me gas is $3 somewhere he is. Haven't seen it. I'm in the heart of Phoenix. Well, you know you could Google this stuff, right? Like here, look, let me show you. Houston, Texas, gas prices. Right? In Houston, $2.70 a gallon, $2.72 a gallon, $2.73 a gallon, $2.74 a gallon. How much is gas in Houston right now? $3.01. You know? And so again, I mean, we can say I'm lying here, but I mean, you know, it's all right. Again, the Q at 364s, SPY at 437s. Crypto will crash deeper. Yeah, I mean, crypto is the one I'm not really sure about. I don't really think the market doesn't have a reason to go up. I think people have to understand it in this regard. The reason the market's going up, there's a couple reasons. Inflation is consistently slowing every month, and it has for the last like 6 to 8 months, I think. So CPI is going down, PPI on average is going down, and that's happened pretty much universally over the last like 6 months to a year. That's one reason the market could be going up. The other reason the market could be going up is that if you look at a long-term chart, you look at a yearly chart, or you look at a weekly chart is a better example of this. It's not like the market's breaking highs right now. The market's actually been in a slump since 2021. And you can see that slump here on a weekly chart. The market's been going like this. Only over the last 6 to 8 months did the market start going up. And generally, long term, the natural state of the S&P 500 is that it's going to go up. That's the reason it's going up, is because long-term stocks go up, at least blue chip healthy companies in the S&P 500. And again, this is very easy to prove because you can look at history and statistics. 6 to 12% on average. 6 to 12% on average is what the market will give you. If I zoom out of the SPY here, that's what you get all the way back for, since before we were born. The S&P's been pushing up. Now, sure, do we crash sometimes in between then? Yes, but that is included in the 6 to 12% statistic, right? So what does that mean? That means that generally on a good year, the market's going to push up a lot higher than 6%, right? And so saying, I don't know why the market's moving up. The market's moving up because that's what happens long term. The whole goal of the S&P 500 is to keep up with inflation. And so if inflation's getting really bad, the market could be catching up to it, especially if inflation is slowing down, especially if... you have to zoom out. You see the market going up. I just think it's the natural state. I think people are trying to bet against the long-term blue chip market. It's a sucker's bet. It's one of the worst, bets you can get involved with. Everybody wants to be Michael Burry, and I get it, but the market's going up because the market's going up, People misunderstand the market. They think it's based off of company health. It's not. It's based off of psychology. And so, but you got to remember what the market's actually used for, which is to hedge against inflation. Gold, for instance, has gone up 4.5x over the last 20 years, 25 years. Gold has 4.5x. So it's right around, I don't know if it's over $2,000 now, but what's gold? GC is gold. So yeah, gold's right under 2K right now. For gold, I think if he doesn't hike the rate, it'll go up, but that's just my opinion. Yeah, for sure. No worries, Mo. I get it. I'm the same way. I have no idea what's going to happen. I trust somebody that says they don't know more than somebody that claims to know 100% what's going to happen. Nvidia is really what's dragging the market up. And I think that's another dynamic of the market lately, which it's mostly driven by AI and tech increases. Nvidia pushing up, Apple pushing up, Amazon pushing up, AMD pushing up. Just PE ratios are kind of out there. And so I will agree with Bears in that regard, which is you could definitely call us extended if you're going by price versus earnings. I understand that extension for sure. But I mean, I guess the question you have to ask yourself in that way is how groundbreaking is AI technology? If AI is really that thing that's going to be the next internet type of thing, that's going to be that influential over the world, then some of these moves in chip stocks might be justified. Again, I'm not saying they are. I don't really know, but I think that's another argument that you could have there. Is how influential is AI? I know a lot of people didn't think it was, but I think when you look at it, it's going to change production universally throughout the world. How you produce things, how things are programmed and coded, and developers, and it's going to change a lot of different career landscapes for people. And so these companies that are on the forefront of that, like Nvidia, Salesforce, Oracle, whatever you want to look at, Palantir, maybe, I don't know. They could have crazy bull runs moving forward still, but I don't know. The question is, are they extended now? And I think a lot of people would say that, but who knows? The report comes out. So the rate hike decision comes out in the report at 2 p.m. So in about 28 and a half minutes, the rate hike decision will be announced. We'll cover it here live. But yeah, about 28 minutes, we'll get the rate hike decision. And then 30 minutes after that, we're going to have the press conference. And we'll stream both of them live. But freaking scammers in the comment section, man. They're like, wow, what an amazing... They try to pander. They try to compliment you. Say, what a great video. You know who else likes videos? My mentor, Deshaun. He is the greatest ever. He made $7,328.38.5 yesterday, trading Forex. Joined by WhatsApp. Again, Q is pulling back a little bit. We do have the SPY at 437s. Nvidia at 418.50s. Do you think gold will go up or down? I don't know. It depends on what Jerome Powell says. What if Pepe goes to all-time highs? Honestly, I'll be kind of bummed out I didn't buy it if it does. I'm not really a big Pepe holder. I'm in fact incredibly skeptical of it. But I can't lie. If it goes to like some crazy, ridiculous number, I'm gonna be super bummed out. I'm gonna be super bummed out because that'll be like the next crazy run in crypto, and I'll be bummed out I missed it. Yeah, the GOAT. No, Deshaun was actually a real name. They would say in the comments. They would be like Deshaun, you know. And it's always like a really specific number to try to be more convincing. And so, yeah, Deshaun's actually a real name that they use. I think they stopped using them because I made fun of them so much. But yeah, this isn't a bull market in my opinion. Just people chasing yields. Could be wrong. Pepe's done. Yeah. I don't know. I haven't looked at it. Go study the market psychology chart. Complacency. People don't change behavior. Yeah, but okay. Let me draw this out. This is the easiest way to put it. Okay, so like the general state of the stock market goes like this, right? The S&P 500 is what I use, but it's the same with the Dow. Like whatever broad market ETF gauge you want to use, that's fine. But the general state of the market goes like this. Market goes up. People get greedy. Greed causes a major downward move. People start buying at the bottom. Market continues to go back up. It goes up enough where people get greedy. You know, eventually you get another big correctional move. The market keeps going back up, right? Like that's the general state of the market. It's been that way for a century now. Like that's what happens. You know, again, I can show you the actual chart now to back this up. Look, if you look at a weekly chart on the S&P, I'm going to put up the actual S&P because it's easier to track long-term moves. Right. So here is the actual S&P 500, and we will look at it at the max lifetime of the S&P. Look, same thing. Again, what happens? Let me zoom out a little bit more if it lets me. But again, this is typically what happens. Look, market goes down, big correction, people get greedy, big correction, market goes right back up. Market goes back up, people get greedy, big correction. Eventually we bounce right back, start going back up. You zoom out a little bit more, market gets greedy, big correction, market ends up going back up. You zoom out even more. Market does the same thing. People get greedy, market goes up, big correction, market continues to go back up. Now, sometimes they're closer together, and sometimes they're farther away from each other. But the same thing generally happens over and over again. And again, so like if we zoom in now of the market, we're actually on the way back up after the latest correction, which was in 2020 which was in or late 22 or late 21, early 22 was the last major correction. And we had trended down from that for the last few years. And so at this point in time, the market's on the way back up from that. Now, again, I'm not saying we can't crash again. Sometimes that does happen. But it's not like, man, things just don't add up. The market shouldn't be going up. Maybe, but I don't know. Again, nobody knows. I'll put it this way. People have been telling me the same thing, like the market has to crash. Watch, it's going to crash imminently. They've been telling me that for years. And we can just kind of keep going up. And so what happens is people miss out on the true edge of the market, which is that long-term the S&P 500 goes up because they stay scared. And again, maybe this situation is right. Maybe we do crash and all that stuff. But, you know, I don't know. It's possible. Yeah, for sure. But I think even smarter people, sir. Sir says the market drops when people take money out. If no one takes any money out, it won't drop. Smart dudes take a chunk of money out at the top and leave greedy folks with a bag. Sure, correct, right? But even smarter dudes just kind of let their money sit for 30 years. You know, like the best money, the biggest, most profound edge the market ever gives you is that it'll give you about 6 to 12% a year. You let that compound over 30 years, you're going to turn a small amount of money into a very large sum, right? That's what the smartest money does. The smartest money doesn't worry about crashes and short-term price fluctuations because they're holding it for decades. And that's the major difference. Now, sure, you have day traders in between that. You have swing traders. That's fine. I do both of them. I swing trade, I day trade, and I invest. And so I understand that. But again, we got to look at the real edge, I think. And again, we got about 23 minutes until the market closes, or I'm sorry, until the rate hike decision happens. Yeah, hey, it's all good, Justin. Listen, he says, I admit it, I'm a hard bear. I make much more money with much more confidence when things fall. Hey, I'm not mad at it, man. Make your money, dude. All good, man. You know, good luck. I'm sorry, but I get a lot less for my money now. I used to buy whatever I wanted. Now I have to. Yeah, maybe. What asset class is better to hold over 30 years? I think it's either going to be, I mean, it's one of three things. It's either going to be real estate, gold, or the S&P 500. I think gold has done better over the last 20. Gold is 4.5x over 20. S&P 500, I believe it's about 3.5x. So it's close, but gold has been a little bit better performing. I think Bitcoin has actually performed better than all of them over the last 15 years. But it's a relatively new asset that doesn't have as much time. It doesn't have as much stats on it to really gauge safely, I think, yet. But I'm a big believer in crypto too. But in terms of like long-term investing, it's certainly more vulnerable, considering it kind of goes against the banks, if that makes sense. Yeah, investing time in the market beats timing the market 100%. But is this trading gold? No, I'm not really trading anything right now. I'm going to wait for the decision to happen, and then I'll take some trades. I think trying to predict what's going to happen or what Jerome Powell is going to say ahead of the time is a lot of the time just a coin flip like gamble. You know, you might as well play roulette in that situation over trying to predict what he's going to do. Nobody really knows. You got a 50-50 chance of being right, though. I mean, I guess 33% chance of being right if you consider neutral reaction. But yeah, a lot of people play strangles on this type of stuff too. Not me generally, but a lot of people do. Right, so here's the S&P right here. It's about 43.74s. We got Nvidia on the right side at 420s. DCA into your favorite cryptos. I've got a Roth IRA. Here's the reason why there are short bias traders. The stairs up but elevator down price action is easier for people to sell their shares to protect profits than it is to buy and risk. Sure, I understand that, but it all is relative to the time frame you're using. To pawn. I think I agree with you, which is mostly that short-term. I like shorting short-term much better than going long. I tend to have much better results shorting than I do going long. But I think when you zoom out long-term, the real edge is on the upside. And again, it's subjective, though. It really is. So again, it could be either one. Because like, again, what Pawn's saying is that there's a very common saying. It's called it's called longs take the stairs, shorts take the elevator. And it's absolutely true. When you see, it's because fear is a stronger emotion than hope is. You know, so short-term momentum. When fear gets there, people rush out of their trades. You know, more than like optimism. When you buy stuff and when you buy up shares, optimism is there, sure, but fear is much stronger than that optimism. And so it's one of the reasons you'll see the market just dump down on people because fear is strong emotion. Numbers drop at 19. With the skip this month, do we expect US dollar pairs to rise? Probably. But they might have already, if you're talking about just general equities, the market's already gone up a lot. So it already could be baked into everything. And that's a interesting way to look at it in terms of like, hey, you know, a rate hike is generally going to be seen as negative. A skip is going to be seen as positive. But the market's pushed up a lot over the last, like, again, here's a 20-day chart, which is a look at this is the S&P on the last 20 days, just a huge green move. And again, it could be because people are already front loading into a lower inflationary expectation, because CPI, PPI both came in lower than expected, so they could be getting baked into that, or they could be also expecting the skip, and that's that's the justification for the market pushing up. I don't know. I think those are all plausible for sure, but people might just be confident. It also could just be AI pumping everything up. With Microsoft started it, and then Nvidia, and Nvidia's basically been the latest one that's been going crazy. Microsoft was before that. I don't know if you remember, but Microsoft popped up a lot when ChatGPT, when they ended up buying out ChatGPT, basically OpenAI. If you look at Microsoft over the last year, they have been very strong, basically since January this year. So Microsoft is really the reason. Like here's this year of Microsoft. Here's 2023 of Microsoft. Very steep curve here. Very steep curve. And so this is what really started the AI hype in the stock market, is Microsoft. Again, after that, Microsoft affected the rest of the chip stocks. So they affected everything else, and kind of sympathy dragged them up. But again, Nvidia has been the latest one, which again, if we look at here's Nvidia this year. So Nvidia has just been crazy powerful this year. And again, the S&P started to dip down a little bit, but it's still very green. We can look at the dollar index and see, like, again, the market tends to be sensationalized, and I'll explain how. Okay, it's like, okay, over the last few years, prior to the last 8 months or so, the dollar index had been pumping up too much to where inflation was high, the dollar was rising. It was too extended on the upside. And what did people say? They say, oh, inflation's rampant. It's the worst thing ever. It's the worst thing. The dollar's too high. It's the worst thing ever. And I agreed with them. The dollar was super extended. We needed a correction. If you look at the dollar on a weekly chart, the dollar was surging up in 2021 and 2022 for the most part. Everybody said, oh, man, the dollar's super extended. The dollar's super extended. It's the end of the world, they basically said, right? And then basically for the last, the last 7 months, 8 months, 9 months, what have I heard? I said, oh, the dollar's crashing, guys. It's the end of the world. The dollar's crashing. And so it's like, no matter what the dollar does, people are going to sensationalize it. If it's ripping up too much, they're going to say, oh, no, inflation is terrible. And inflation was bad. But then when the dollar starts to drop, oh, no, it's the end of the world. The dollar is crashing and failing. It's just sensationalized. A lot of it is political, because they're trying to make the opposing political party look bad. And so they have to make it seem like things are just the worst ever. I think it's better to just take a step back and look at things objectively and understand that these drops in the dollar this year and since October have been pretty good for the market. We needed that, especially with inflation being bad. So if I was Oracle, I would never stop saying AI. That's all I would say. I'd say AI or AI systems, If the rate is lower than 5 or 5, will you guys open a longer? No. I don't know. Are you mentoring in crypto? No, I'm not. Who are you? I'm John. What's up, man? This is my channel. US 30 to the moon. Yeah, the Dow has been flying up. Here's the Dow right here. I think the Dow's been going up, right? Yeah, here's a yearly chart on the Dow. Dow's been going up since June of last year. Hasn't really reacted this, like the Dow's been a little harder to move up over everything else, but it still had a pretty green year. Here's the, oh, actually the Dow's not really green it's slightly green, barely green, but it's green. It's gone from about 33 to 34K. FOMC is at 2 p.m. in about 14 minutes for FOMC. Rug pull incoming, man. I've been hearing it for 8 months. I'm skeptical. Maybe, I don't know. Yeah, it's human nature, I guess. Why? Yeah, Coinbase. Honestly, I understand I understand the worries regarding Coinbase, and I think the SEC is ridiculous. They're intentionally ambiguous and vague. You don't know what they're saying. They won't define it. But they're like, hey, well, can you define what we consider? Can you tell us which ones are securities? They're like, no, we're not going to tell you which ones, so you can correct it, and then we're going to sue you because you're listing securities. They say. Gary G actually held a course when he was a professor about crypto. He actually taught crypto. He had a class called blockchain technology, I think it was called. And so it's kind of ironic that now he's one of the biggest opponents to it. It's like, bro, you taught people this. Now you're mad they're doing it. I don't know, man. I think it's funny. Just sold everything. I sold everything yesterday. What's up, David? He also applied to be a Binance advisor in 2019. Yeah. I'd say no, too. SEC might be buying coin calls and had a day with it with $2 million fine. A rug pull in 23 is only worth a 10% stock retracement. Yeah. Hey, will you be playing the Fed meeting? Yeah, we're going to stream the full FOMC meeting live like we always do. So, yeah, we'll stream the whole thing. Again, subscribe if you haven't yet. Hit the notification bell. We appreciate it. Yeah, I'm ready, man. I'm ready. Again, very probable that we're going to skip this meeting. It's actually fluctuated a little bit more. Right now, it is currently at it's still at 98, with 2% of people thinking, 2.3% of people thinking that we're going to not raise rates. That we're going to raise rates. 2.3% of people think we're going to raise rates. 97.7% of people think that we're going to skip or pause or whatever. Market crash is unlikely. Again, people say it every major FOMC, CPI report, Fed meeting, PPI report, Jerome Powell press conference. Every major one, people tell me the market's going to crash. And again, in terms of that, it's unlikely. Market might drop. We might have a red day, but it's unlikely. Did you have some good trades today? They were all right. I took some profit on my swing trades. I didn't attack the market super heavily because of, a lot of the time you don't know what's going to happen a lot of the time you don't know what's going to happen here for the market. Like, you don't know on major release days like today. A lot of the time you don't know what's going to happen. The market will be apprehensive and nervous. And so sideways and choppy a lot of the time ahead of these big reports. It's just not super easy ways to make money, but today's a little bit different, to be honest. Here, the market had a really nice upward trend all morning. Only started reversing midday, and Nvidia and other stocks have been holding really, really well with really high volume. So I mean, we'll see. I don't know anything about Brink's trade. Is that like a overseas strategy? Would be awesome if he raised. Reality sets it. It's unlikely though. I think I wouldn't mind. I don't mind if they raise rates. I think it's okay. I think inflation's showing okay signs, and if we're really shooting for 2% inflation, then raising rates is kind of what they need to do. The whole reason they don't want to, and the people that are really pushing against it, are the banks. The banks don't want them to raise rates again. In fact, the regional bank failures we had with FRC and all the other regional banks that struggled at the beginning of the year was they blamed it mostly on the rate hikes. Because again, to explain the process, every 6 weeks the Fed raises rates, let me rephrase that. Every 6 weeks the Fed decides on whether they want to raise or lower, skip interest rates. If they raise rates in a situation when inflation is really, really bad, and vice versa. And so what they do when they raise rates is they raise the federal funds rate. By doing so, that makes banks makes banks harder to make money. It hurts their margins, so to speak. And so what do the banks do in return? They raise interest rates on consumers. When people raise interest rates on consumers, what happens? They stop buying as much. When they stop buying, businesses in turn lower prices. That's the cycle of it. That's why they raise rates. And inflation has been getting a little bit better, but that's the cycle of it. And then weeks after that happens every 6 weeks. Again, at 2 p.m., the rate hike decision will be announced in about 9 minutes. And then at 2:30, we're going to do the accompanying press conference that goes with it. It depends on what happens, though. We're going to stream the full press conference live, but most people expect them to skip today. Jerome Powell speaks at 2:30. The reaction, Michael, he says if they don't raise, dollar goes down, right? The reaction is not super known. Like, we don't generally know what's going to happen with the dollar index or with the equities market. Again, the argument now is that the market's pushed up so much over the last couple months that, or over the last 6-week cycle, then people could argue that we're already extended on the upside. So people could argue that we're already baked into this expected decision with a pause or skip. Again, I don't know. I don't know. I think anything could essentially happen here, but. So right now, so again, I'll show you guys how you find this data too. But again, it's going to be better for y'all. Again, we get thousands of people here. And the reason we do is because we cover the data quickly. So we'll cover it probably before you'll be able to look it up, I think. And again, but if you want to look it up, I'll post this link here as well. So here is the FOMC page. You can see the May reading here. This is the last meeting. Today is June 14th. So this is the one that will drop. You can see the statement is here, right? So for instance, the last one, if you scroll down on the last one, it said they raised the target range for the federal funds rate to 5 to 5.25, right? So if we look at today's, the one under June 14th, if we look at today's and it says they're not raising or it's going to stay at 5.25, that means they're skipping or pausing. If it says then 5.25 to 5.5 or 5.5, then that will mean they've raised rates 25 basis points. But again, you find it here. Again, it's going to take you a while to interpret it. I interpret it pretty quickly. I'll look it up for you, and it'll probably be faster. So subscribe, hit the notification bell, and then at 2:30 we're going to stream the full press conference live as well. So at 2:30 we will stream the press conference live. Again, I'll put this number up in chat if you want to check it out. Not necessarily break. So if we do pause, which is overwhelmingly expected, what it ultimately means if we do pause, which is again overwhelmingly expected, what it will mean is that what's going to matter more so if we go in as expected with a skip or a pause, what's going to matter more than the announcement of the decision there is going to be what Jerome Powell says during the actual meeting, right? So you could look at what he says and see what he says. Sometimes he'll say things like he'll say inflation remains elevated, chances of a recession are high this year. He could say chances of a recession are low now this year, or much better this year. That should make the market go up and vice versa. So you got to just listen to his tone. A hawkish stance by the Fed means that they're pushing for a contracting monetary policy, which is like aggressive rate hikes, trying to curb inflation with aggressive rate hikes. That's hawkish. Contracting monetary policy is what it means. Dovish means they want an expanding monetary policy, right? So they want to skip or pause. That is what they ultimately mean. And I'm not sure what we're going to get here, but we'll see. Yeah, the actual press conference will be in 35 minutes, but the decision on how much they're going to raise or lower rates is going to be in 5 minutes. And again, make sure you hit the live button next to the play button. Make sure you're caught up on the stream. So again, make sure you hit this button, guys, to make sure you're fully caught up. So make sure you hit this button. You see the live button next to the play button. You want to make sure you click it and it stays red. If it's red, it means you're live. If it's gray, it means you're behind. Yeah, I could add Bitcoin. Here's Bitcoin right here. So I'm going to put up Bitcoin on the left at about 26K. I'm going to put the dollar index on the right, which is the dollar, which has been dropping all day. And then I'm going to put the S&P 500 up in the middle. All right, so here's the S&P. You can see the previous closing price down there. We're right above that. So the S&P is technically green on the day. Previous closing price is the level it goes from red to green, green to red. All right, guys, we got 4 minutes here. 4 minutes, team. Hey, what's up, Abe? I'm good, man. I'm good. Hope you're doing good, bro. If there's a pause or skip, I just want to say one thing as a loving father of 2 young. Let me skip that one. Yeah, I don't know what half of you guys are saying in the chat, man. What about gold? I mean, I could try to put gold up. Would y'all rather the dollar index or gold up? On the right. I guess I could ask you guys. We got 3 minutes, guys. 3 minutes. rate pauses, what stocks to buy. I have no idea. I don't know what the market's going to do if we pause. I don't know if the market's going to consider us extended on the upside already. So even if we pause, the market dips or it stays neutral. I don't know if the market's going to be so optimistic in a pause that, you know, the market's going to pump up more. Again, what's ultimately going to matter more, though, that than any of that stuff, if we come in as expected, which is a pause from 5 to 5.25, if that happens, then I don't know. What's going to matter more so than the actual announcement is going to be what Jerome Powell, Big Papa, says. And again, we'll have to wait and see. He doesn't speak until 2:30. And so we'll have about a 30-minute lag in between the rate hike announcement and when he actually speaks to gauge price action going into it. Let him cook, Big Papa. Hey, the man, the GOAT. Honestly, Jerome Powell's got a hard job, bro. I mean, I can't say I wouldn't take it, dude. Somebody comes up to me and they're like, John from Beginner Trading, please be our next FOMC commissioner. I'd say sure, you know. But it's a hard job, man. Everybody hates him. If the market struggles, everybody's mad at him. But if the market's flying up, they never give him credit for it either. Hey, thank you, Michelle, for becoming a member. I appreciate it. Thank you. Yeah. I appreciate you becoming a member. Now you have access to the great coveted special emojis. Hey, we got a minute and a half left, guys. A minute and a half left. I just subbed. Hey, thank you, guys. Oh, I got to put it in sub-only mode here. Hey, all you new guys, y'all hit the subscribe button. I would never pressure you, but if you don't, I'll hate you forever. Sub right now. Do it now. Hey, we got a minute and 15 seconds, guys. Again, hit the live button. Make sure you're fully caught up on stream. I appreciate it. We got 1 minute until the rate hike decision is announced. Again, should I have gold or the dollar index on the right side? Let me know. Hurry up. We got 1 minute. Hey, what's up, Wesley? Gold or the dollar index? Which one? Right side. Dollar index. Dollar, gold, dollar, gold, dollar, dollar. Okay, most people say dollar index, so I'm just going to stick with that. Sorry, gold. This isn't the blood and Crips, okay? I appreciate you guys as well. But I'm going to put the dollar index up on the right. S&P 500 is right here. I'm going to put the SPY up instead of the S&P, actually. All right, guys. Hey, we got 30 seconds. 30 seconds. 30 seconds. Will we pause or skip, guys? Hey, 20 seconds here. 20 seconds. Let me get my page up here so we can actually fully cover this. Hold on. Again, 20 seconds. Again, we're going to stream the full FOMC meeting as well. So after this rate hike, it's not over. We still got 30 minutes and they're going to do the press conference and we will stream the entire thing. So stick around. Here we go. 5 seconds. All right. So there it goes. Market is dropping, but it's not dropping enough to signal a rate hike. Hold on. Waiting. All right, there we go. We are out here, and all right, so they paused or skipped. They maintained it at 5 to 5.25. They maintained it. They paused or skipped. As I told you guys they would. All right, they paused or skipped. Again, it says the U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risks, and the committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. And in support of these goals, the committee decided to maintain the target range for the federal funds rate at 5 to 5.25%. Holding the target range steady at the meeting allows the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in the previously announced plans. The committee is strongly committed to returning inflation to its 2% objective. End quote. And that's from the FOMC meeting. Interesting how the market's reacting negatively to this. It's not a huge negative reaction. We're still at like 436s, but certainly interesting to have the market react this way from this. And again, the actual full press conference is going to be streamed live in about 29 minutes. So stick around. We are going to stream the full press conference. So again, stick around. We are going to stream the full FOMC press conference. Market's dropping down to 436 on the SPY. Dollar index is loving it, going up. Bitcoin down to 26K. And yeah, we'll see if it actually holds here, guys. But Jerome Powell's about to speak again at let's get ready. Jerome Powell, Big Papa's about to speak. And so again, we'll see what happens. 2:30, guys. Market's consolidating a little bit right now. Again, stick around. The actual press conference is going to be in about 27 minutes, and we'll stream the entire thing live. Subscribe if you haven't yet. We appreciate it. Vote was unanimous. 54% of people still think we're going to have a positive reaction. And we might. I mean, this isn't, we're dropping right now. The dollar index is moving up, but it's not like a crazy big drop or anything like that. And again, if you haven't already, guys, check out Top Step. Top Step is a sponsor of mine. They're a funded account program. You can day trade these economic releases, and the futures market has no PDT rule. Most pro traders gravitate towards futures because the futures market has no red tape. You can day trade short in futures. You can day trade the S&P. You can day trade the NASDAQ. You can day trade currencies. You can day trade gold and silver. In futures, no PDT rule. And so these funded account programs are allowed, and they're much cheaper to learn. So if you're trying to learn day trading, a funded account program should teach you how to trade a little bit better because there's less risk, but there's still a great middle ground of pressure. What they do is they give you a demo. If you can hit the target on their demo while following their rules, they fund you between 50 to 150,000 with a 90% split once you're funded. So if you make 20K once you're funded, you keep 18K. If you don't get funded, which most people are going to lose these, and I'm biased in their favor for sure because they're a sponsor, but most people are going to lose these, but it's a lot cheaper to lose one of these than to put up like 5K yourself and risk that, or 10K yourself in futures and risk that. And so it really is a great middle ground of pressure. If you want to learn to day trade without taking on too much risk, try out these funded account programs. Here is the link. A great way to help support the channel. And again, the market's dropping a little bit. We still got about 25 minutes until the actual rate hike decision is announced here. Powell's going to talk at 2:30. We still got 25 minutes. Again, we'll stream the whole thing. So we still got some time. But again, let me know what you guys think. 53% of people still think we're going to have a positive reaction. I don't know. Yeah, Big Papa coming in 25 minutes. I'll put this up on screen so they can see. But again, all right, full press conference is going to be streamed at 2:30. So, stick around. Full press conference streamed live here at 2:40 or 2:30 Eastern Standard Time. Again, PPI came in lower than expected today as well. So that's an interesting dynamic too. PPI lower than expected as well. Market started to drop a little bit. NASDAQ going down pretty hard. Yeah, we can look at it. There's crypto. What's gold doing right now? Here's gold on the right. Gold is falling with the equities market, which is kind of what we expect. Gold trends most of the time with equities. Nvidia dropping down, Coinbase dropping down a little bit. Is it time to buy the dip? I don't know. Because he is pausing, he will be as hawkish as he can. I mean, that's plausible. Kramer said that he thinks that they're going to do what's called a hawkish pause, which is, it kind of contradicts itself, but still. Why is the market going down? Result as expected, probably because we pushed up so much in anticipation of this. So again, you look at a 20-day chart, this little dip is nothing. And so we might just be correcting a little bit from the last 20 days of huge bull greed action. Market's been flying up. You know, it's at 434.80s right now. So it's probably that is realistically what it is. They didn't increase rates at all. They paused. It's again, so stick around. I'm going to put a timer up. That's one thing I forgot. So I'm going to put a timer up for the actual press conference here today. Let's see. It's going to be in about 23 and a half minutes. All right, so here is the timer. So this is when the actual meeting starts. And again, we'll stream the whole thing. Gold's still dropping down a little bit. There's the SPY dipping still. So the SPY is falling pretty dramatically in all this. But again, even with this, it's not the end of the world. Like, again, if you pull up a 20-day chart and look at how much the S&P is ripped up in that period of time. So like this drop doesn't mean too much yet. It's not like this is a crazy crash or anything like that. What's going to matter more though, again, since we came in as expected, guys, what's going to matter more than any of this stuff is what Big Papa Jerome Powell says during the actual FOMC press conference. That's what's going to matter more than anything else here. And so, yeah, I'm kind of looking at chart prime. You know, I'm looking at these. to see if we get any good trades. Like a lot of the time I've been using Chart Prime to base my trades off of. And again, I think the real edge for Chart Prime, they are one of my sponsors, but like, look at this. They're genuinely useful. You can use them on the S&P. You can use them on the NASDAQ. You can use them on stocks, crypto, Forex, futures. They give you reversal signals. There's a bunch of indicators. They show you flag patterns, candlestick patterns, and it's like $35 a month. It's very cheap. I think the real edge is if you use the regular market oracle and you wait for multiple things to show up within like a 5-minute period or like a 15-20 minute period. So here's a reversal down signal and a bearish engulfing candle, and we have basically dropped since then. Reversal down signal here, we drop. You can also see the same thing in pre-market today, where if you pull up pre-market session, look, so you get the same kind of thing here, look, where you get multiple showing up within like 20 minutes, especially if they're at the same candle, you get drops over the next like hour. And so really, really interesting. And again, this is just a small piece of what they offer. They also show you like triangle patterns. There's even a shorter term version, but you can use this on any time frame. You can use a 1 hour chart and see the same thing. You can use a 1 minute chart and see the same thing. And again, they can be pretty useful. But there's also multiple indicators. So you can see here, there's the Market Oracle Pro right here, where if you want to see that one, they're going to show you a bunch of stuff too. It's going to be a little bit more meant for short-term trading. And again, the real edge is when multiple indicators showing up at the same time. You can also look at like smart money concepts here too. So if you like smart money concepts, they'll show you those as well. And again, it's a trading view indicator. Like, but look at this. Look, strong sell signal at the very top of this. Look, nice drops. Down, buy signal here, bounce. Strong sell signal here, drops. Sell signal here, nice drops, bounce, bounce. And so and look, they literally called the sell signal here too once they saw that first candle from the FOMC. And so again, genuinely useful. It's $35 a month. Check them out. They are a sponsor of mine, but again, genuinely useful, I think. This drop baked in? I think the market was baked in on the upside from the expectation of this meeting. And again, you can find all the sponsors I have in the description if you want to check them out. But I think this was baked in already. I think most of the market expected us to pause today, 98%. And so I think with that, most people, again, started riding the market up, not today, but the last couple weeks. If you look at a 20-day chart, again, it confirms that that concept, that thesis here. Like if you look at a 20-day chart, the market's ripped up drastically. And again, I think this is from people expecting lower CPI, expecting a pause on rate hikes. But again, what's going to matter more now is what Jerome Powell says during the actual press conference. Again, that is in about 20 minutes, guys. 20 minutes. We'll stream the whole thing live. All right, we're at 434s on the SPY. Bouncing back a little bit here. He taught blockchain doesn't mean he's pro blockchain. Law teachers are not pro criminality. Look, I'm not trying to make fun of you here, but that's so easy to dispute here, bro. Okay, you got it wrong, dude. You said that wrong. He taught blockchain. No, but you know what law teachers do support? The law. He taught a blockchain course. How can you be anti-blockchain and then teach about blockchain? It's kind of like being anti-law and teaching the law. You know, it doesn't make any sense. Unless I'm misinterpreting your comment, which I don't think I am. If I do, I'm an idiot. If I am, I'm an idiot. But, you know. But if not, you know, I think you're wrong, sir. Yeah, let's see if we bounce back here. Don't go to Nvidia. Don't buy it. Nvidia's a little bit too high up for me right now. I was in the SOXS ETF, which is a short Nvidia ETF, and I was holding it for like a week, and I think I made money on it. But I covered it yesterday, and I'm glad I did because Nvidia is popping up at 417s. Why did the market react so negatively to a positive result? It's not really positive. It's just expected, and so it's kind of neutral. And again, this move is pretty much nothing. So like this big downward move is not much, you know, it's not like it's a crash, like which would be way down there on a daily chart. This move is nothing, especially if you look at like the grand scheme of things. Well, we can look at like a 180-day chart. This move is this, you know, is it a good move? No, but it's still pretty early. We got to wait for the actual press conference first. The short Nvidia ETF was SOXS. It was SOXS. It was I think it's short microchips, but I might be wrong there. Yeah, he said it was rigged because he lost. Yeah, nobody cries manipulation more than somebody that was wildly wrong about a penny stock strength. You know, don't hate me, guys. This is a liquidity grab. Yeah, maybe. It depends on what he says. Tesla was a great dip buy. It honestly was. I was talking smack about Tesla at $100. So I mean, I was wrong, 100%. Now I feel dumb. Should have bought it. Should have held it. But of course, hindsight's 2020. Get your money back. I just want to know how many scripts and programs are running right now. For me, personally, I got Mumu, WordPress, Quant Tower, a bunch of Google Chrome tabs, TOS, WordPad. That's about it. I got TradingView up. I got music playing in the background. I've got like 60 plus gigs of RAM though, so I updated my RAM a long time ago, so I can do it. But somebody convinced me to buy an Apple. I'm still not talked into it. I feel like I can get a much better computer for like $1,500 than paying like $3 grand plus for an Apple PC that I can trade on. Am I wrong there for thinking that? Again, market's starting to retrace a little bit here. Bouncing back a little bit. Again, we got 18 minutes into the actual FOMC press conference. No poker in the background. Not today, bro, honestly. The problem with the poker streams, dude, I stopped playing poker in the morning, man. But again, the problem with those streams was that, like, I would play them and I would zone out too much. And so I'd be sitting there playing poker in the morning. I'd be mad. It would reflect on my trading negatively. I'd get tilted in poker and then I'd go on tilt and trading. It was just not a good move. Never trade and play poker at the same time. You know, you get pocket aces cracked, you're going to start buying 1,000 shares of Tesla and just getting destroyed, you know. Yeah, take the money you save from Apple and get a new good video card. Not looking forward to JP's hawkish tone. Maybe he's hawkish. I don't know, man. We'll see. I'm not going to be specific about where I play. I don't even know what poker is, bro. What's poker? But no, I'm not going to tell you guys where I play. Haven't used the new iMacs, but they look and seem pretty sleek. Yeah, I mean, I can't even lie. Like, I'm a Galaxy guy. Like, I'm a Samsung guy. You know, I've got the Z Fold here. You know, but like, and I always like Samsungs more because, again, I come from like a developer background where, and I know people use Macs and Apples for devs too, but you know, again, when I grew up, I was downloading Pokemon ROMs and emulators, and like, you know, I'm too restricted on an Apple, I think. But I will say, the rest of my family, my daughter and my wife have Apple phones and stuff, and so and every time I use their phone, I kind of like it. I feel bad for liking it, but I do. And so part of me is tempted to buy an Apple laptop, but they're just so expensive. You get like 8 gigs of RAM and a crappy video card for like $3,000. It's just a hard sell for me. SPY at 435s. Again, we're dipping down a little bit. We'll see if this is just kind of a flag on the downside, a bear flag, or we'll see the market continues down. Gold is bouncing back, though. So gold is bouncing back. It's basically retraced over 50% of the downward move that it made. And again, Nvidia started to test the volume-weighted average price, so we'll see if it actually holds. Yeah, I mean, maybe you're right, Wyatt. Maybe I'm just overly loyal to... That's what it feels like, I guess. Samsung guy, red flag. Stick around. He's always hawkish. What about reversal from Power? I don't from Powell. That Powell 2-jack offsuit. My favorite hand is probably like 10 jack suited. That's probably like my favorite hand. That's a really hidden hand that can flop some good stuff. Gold left a nice. Yeah, gold retracing back up a little bit. It started putting. It looks like this was kind of a bear flag though. But again, it still doesn't take anything off the huge run that the market's been in. So like if we look at the market, here's a 20-day chart. And so the market's just been on a huge run for 20 days. Like here's the market run for the last 20 days. You know what I mean? So like even if we pull back like this, it's kind of on the stair step pattern of going up. You know, and again, I don't know if we're necessarily going to continue going up, but like that's kind of what it is. It's kind of the stair step pattern that we're seeing. Why do people not get a high market as inflation, Tory, and Powell and the Fed are going to chop it down? I tend to agree. I think it depends, though. I think inflation's getting better. And inflation dropped yesterday and today, too. So PPI dropped this morning, CPI dropped yesterday. And so I think it's arguable. I don't think anybody really knows what Powell's going to say. I think we could try to predict it, and we got a 50-50 chance. And I'm sure the people that said we're going to drop from Powell's comments are going to celebrate. And the people who said we're going to rip from Powell's comments are going to be bummed out. But I think it's a 50-50 shot, and I don't think anybody really knows. I think Powell doesn't want to crash under his watch. And so I think I think we could have been a little bit more aggressive in the beginning with rate hikes. And I wouldn't have minded if we necessarily raise rates here. I think if he really wants to hit 2% inflation, you kind of need to raise it again, which is the question going into this rate hike decision, though. So to be honest, the question going into the press conference, is going to be, does Powell talk about what we do in the next cycle? So in 6 weeks from now, they're calling this one a skip because it means rate hike, skip, rate hike again is why they're calling it a skip. They're basically skipping one rate hike. Now, that's going to be the true test of what the market does and what happens, because if Powell says something optimistic regarding rate hikes in the next cycle, so basically saying that we're not going to raise rates, that could cause huge surges of optimism in the market. If Powell says something like, yeah, we're going to go back to raising rates in the next 6-week cycle, that could cause drops, or I'm not sure how the market's going to respond to that. But I know if he says we're going to potentially stop raising rates for the rest of the year or something like that, the market's going to go up. The other thing to pay attention to is like the word recession. And so the last FOMC meeting, Powell talked a lot about how, there were some chances that we would hit a mild recession this year. Right. But the market has been a lot better, a lot stronger since he said that 6 weeks ago. And so, again, the real question now is, does Powell mention a recession? Do we have recession fears to worry about? Because the two play off of each other. The more aggressive the rate hikes, the more likelihood of a recession. The less aggressive of rate hikes, the less likelihood of a recession. And so because the whole point of raising rates is to discourage spending. And when spending is highly discouraged, what happens? We go into a recession. So I think there's a lot of things to consider there. But yeah, I think those are a couple things that you want to pay attention to for this press conference. And again, we're going to stream the entire thing. You can watch the whole thing live right here. We'll stream the full thing live in about 10 minutes or so. Yeah, I agree, Demetrius, for the most part, that there's no way Powell's going to be. I think that the likelihoods are a little bit closer than that. I don't think there's no way anything can happen. I think Powell could be really aggressive in terms of hawkish tone. He could be really aggressive with a dovish tone. I don't think he has to do anything necessarily. And I think the true response he's going to have is going to be somewhere in the middle. It's also important to watch how he responds and answers questions. They're going to do their Q&A at the end of this, and what his answers are to that Q&A are going to highly influence the market as well. Again, we got 9 minutes here, guys. 9 minutes. So again, if you haven't already, subscribe, hit the notification bell. We appreciate you guys. And yeah. All right, so if you try out Moomoo, and if you don't know what Moomoo is a zero commission stock trading platform. There's zero commission on their stock and option trades. They're open 24/7. You can place orders 24/7, similar to what Robinhood did. But by signing up with a deposit of, minimum $100 deposit, you can receive up to 15 free shares of stocks, up to 15 free shares of stocks with the sign up to Moomoo. And yeah, I think that's pretty dope here. I'm going to start trading on Mumu. I'm probably going to switch. I might still use TOS, but I'm probably going to switch to Mumu because they've got a lot of the things that I'm looking for, like 24/7 trades. I'm at least going to put in 25K over there, I'm pretty sure. And again, if you want to check them out, they're pretty cool platform too, man. Like if you look at their platform, it's very similar to like Webull, but there's VWAP, there's EMAs, just good platform all the way around. I would say it's a lot like Webull, but it's just really cool platform. I like the charts. I like the thing. And again, you can get up to 15 free stocks if you sign up, deposit $100. And so again, I'll post this link here if you want to check that out. Great way to help support the channel. Yeah, I'll put the link up right here. I prefer here more humble and very honest. Definitely top 3 most humble guys in the world right now, for sure, without question. I mean, when I think about how humble I am, I can't help but put myself like in the top 3 for sure of most humble guys ever. But I mean, you know, if you don't say I'm humble, I'm gonna ban you forever too. Again, Bitcoin dropping down. It's at 26K right now, under 26K. SPY's still dipping though. I think we broke lows again. Gold's still consolidating after the drops, but we're testing lows right now on the SPY. Look at the SPY down here. Some of y'all are going to think I'm serious and y'all are going to get mad, and that's okay. Get mad. Listen, I'll be your therapist. Hey, listen. I mean, you know, like I said, when you look this good, it's just hard to be, you know, it's hard not to be humble when you look this good, and humility just throws, you know, just flows through you like water. I mean, listen, top 3 most humble guys ever. In summary, Bitcoin is going up or down after this release. The release already happened. Bitcoin reacted negatively. What's going to matter more so is what Powell says during the actual press conference. So what Powell says during the press conference in about 6 minutes is going to influence the market more heavily than the rate hike decision that just happened. Like the market's down from the rate hike decision. But what Big Papa, JP, says during this press conference and his answers to the Q&A and his tone and what he says about a potential recession this year, and you know what he says regarding inflation, what he says regarding what the decision is going to be for the next 6-week rate hike decision next week, which is going to be in August. That's going to matter more than anything else, and that's an interesting part to watch. We'll see. Yeah, we're going to stream the Powell speech. Crypto. Yeah, sometimes too humble, you know. Again, market's consolidating right at the lows here, right at the lows. Hey, thank you, man. Appreciate it. A skip to me is kind of like skipping a car payment and then adding it to the end of the car note. Yeah, maybe, man. All right, guys. Hey, we got 5 minutes here. 5 minutes. Again, hit the subscribe button, hit the notification bell. We appreciate the love. We're going to keep growing. Hit that subscribe button here, team, if you haven't yet, you know. Again, we hit 109,000 subs. So for that, we truly do thank you guys. Thank you so much for helping me hit 109,000. Now, all you got to do is we need about 800 subs to hit 110K today. Do it now. Try it one time. Listen, everything we drop here is free. I might joke around. I'm the best looking guy in the world for sure. Most humble as well. And I know that might rub people the wrong way, but subscribe. Do it right now. Do it right now. I appreciate it. Again, if you haven't yet, everything we put out there is free. You know why thousands of people tune in is because we cover the data quickly and we cover every major market event. You know, when CPI comes out, we drop that data very quickly so you can react to it. So you can pay $30K for Bloomberg Terminal a year, or you can subscribe to beginner trading and watch humility in action. Do it now. Bitcoin down at 25.8K. We got the SPY at 434, bouncing right at that low of the day level right here. So again, we'll see if we hold. You can see the timer at the top left. We got 3.5 minutes left. And again, what do you guys think? Good or bad reaction? Chat, let me know. What do you guys think? Good or bad reaction? Weak beard though? Hey, listen, fair point, man. My beard's definitely weak. One of the top 3 weakest beards in the world, I think, for sure. But no, we'll see what the market does. The SPY is bouncing back up. It's at 434s. Gold at 1950s. Again, let's see if it holds. Good, bad? Beard is great. It's definitely top 3 greatest. Dollar index is down. Yeah, the dollar index pushed up a lot after this decision, so I'm curious to see what happens with it too. The Fed's forecasting 2 more this year. Yeah, it definitely is. Yeah, overflowing fountain of humble fullness. Absolutely. Again, Nvidia back over 417.50s for a split second. SPY bouncing right back at that. We got a double bottom right here too, which is a good spot to watch here moving into this. So we got a double bottom right there. So again, round hit. Make sure again. I say this every time. Make sure you hit the live button next to the play button. Make sure you're caught up. Yeah, we got the conference up. We are ready and waiting here. We got the conference up. Here, I'm gonna start to put some other stuff up on screen. I'm gonna make these a little bit smaller and run these at the bottom. Maybe extend that a little bit. There we go. Let me get this out of the way. All right, so we got the FOMC press conference right there. We're going to put up trading. We might trade some futures into all this stuff too. We got the E-mini right here. So we got the S&P 500 on the left. And again, we start about 20 at about a minute and 20 seconds, guys. And again, if you want to day trade this, look, in the futures market, this is the E-mini S&P 500. So I could day trade the S&P, I could day trade the NASDAQ. The patterns are very similar to stocks. They move with economic data. And the best part is that you can actually day trade the stuff with no PDT restrictions. You can day trade short them with no PDT restrictions. Top Step is the most legit futures funded program in the world. They give you a demo. They test your skill. They give you free funding coaches. If you pass it, you get to keep up to $5,000 a year. Or I think it's up to $10K of your first withdrawal. They pay out millions of dollars a year in actual withdrawals. They fund thousands of traders a year. And regardless of whether you pass it or not, it builds your skill. So it's really good for new traders that are probably going to lose more if they put up 10K themselves. Like most new traders lose. And so this is a great way to limit your risk, still learn. If you're good enough, you can pass it. You still keep 90%. So check it out. We got 30 seconds left, guys. 30 seconds left. Again, I'll put the link up right here. They are a sponsor of mine, biased in their favor for sure. Definitely top 3 most biased ever. And again, we got about 20 seconds left, guys. Make sure you hit the play button or the live button next to the play button if you can. And I'm going to mute the music here real quick. I'm also going to share this real quick so we can make sure that the sound is we can make sure the sound is shared with everything too, so I can make sure that's right. There we go. All right, guys, waiting for this to start. You can see we're fully live. You see the red circle next to everything. My only Papa is Papa John. All right, so here we go. Waiting here, guys. Where's Big Papa? Bring the man out. There he is. All right, here we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the consumer price index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Colby.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including We did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots, stronger GDP, less of a hit to unemployment, slower progress on inflation. And I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast. According to GDP, you've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's again probably going to come slower than we would expect. That leaves the big sector, which is a little more than half, pardon me, of the of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting that there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously in your forecast marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate? Or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable. And that's really, if you think about it, that's what's driving it. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually in reality wind up being lower or higher. And there's really no way to know, but it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place, but it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where is it sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with with an SEP calling for additional hikes. I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. Sufficiently, so I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, more with more data over time.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, then that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time or It's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah, so we've remember we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We want to do that with the minimum damage we can to the economy, of course, but we have to get inflation down to 2%, and we will. And we just don't see that yet. So hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. The last press conference you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank and they wanted to spend. They spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin. And it wasn't really particularly about the labor market or wages. But as you move through 21 into 22 and now in 23, I think many analysts believe that it will be an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Let's go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement? Or are we going to be in a period where we're not going to know what's happening?
I think if you look at, if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%. And the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. You know, we do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecasts, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation. And I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast. And then they send it in on Friday afternoon and we accumulate it and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be 2.8 trillion in 10 years. The CBO also says that federal debt will be 52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We we hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we're on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
Big question.
I would just say it this way. I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and we'll do whatever it takes to get it down to 2% over time. That is our plan. And we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate. If you think about it, inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie. The mic is coming.
Oh, sorry. Thank you. Hi, Chapel. Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in Black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about there are longstanding differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal, and so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic lows, historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up. We haven't quite seen the slowdown in rents show up in CPI yet. And we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, as a factual matter, that's correct. We do need to see, rents bottom out here or at least stay quite low in terms of their increases, because we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and that's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services, excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So we what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. But we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Greg.
Thank you so much, Chair Powell. Greg Robb from MarketWatch. I just wondered if the committee has talked at all about the labor market, and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, we have some workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very, labor economics, and the labor market are utterly central. It's half of our mandate. So we spend a lot of time talking about that. I think, there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on, but we're not involved in discussions or debates over strikes and things like that. But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about, most folks would say now, it wasn't really about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
All right, last question, guys. Last question.
Mr. Chairman, Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
So we're trying to think where to start. I'll start with commercial real estate. We, of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was the non-bank financial sector where issues really arose. And there's a lot of work going on with the administration, in particular, leading that to try to address issues in the treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes. So we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
All right, guys. So that is it for today for Big Papa Jerome Powell. Let me know what you guys think. So the market is slightly red from the meeting, but it's actually pretty close to break even at this point in time. We moved down a lot after the rate hike decision was announced. We have then moved back up some. And so it's really interesting. And again, we'll see what happens here, guys. We'll see what happens. We are going to do a crypto show today talking about the SEC versus crypto dynamic today. So stick around. Don't go anywhere. As soon as we close the stream, it'll bring you to the new one. If you haven't already, again, check out Top Step. If you want to day trade the SPY, basically, you can day trade the NASDAQ. You can day trade currencies, gold, silver, and you can day trade these economic releases. And again, the E-mini in the futures market is basically the SPY. You can see it's the SPY here on the middle side. You can see the E-mini on the right side, and you see it's the exact same price action. You can day trade this right one here with no PDT rule. Top Step in futures, that is in the futures market, no PDT restrictions. Top Step is the most legit futures funded program in the world. They give you a demo account. They test your skill. If you can pass their testing, you got to hit base one. You got to hit 3K without losing 2K, 2 to 3 ratio, reasonable ratio. If you can do that while following their rules, they fund you 50 grand with a 90% split as a proprietary trader, and they pay out millions every year. They fund thousands of traders a year. It really is a great way to get started. Take some risk, but not the full risk you would if you put up the money yourself. You'll probably lose more. Most people will fail these, but again, that's better than putting up the money yourself and losing that, which is going to be much more. A great way to learn. And if you're good enough, you can pass it, get 90% split, free funding coaches. You get to keep your first 10K. There's the link right there. Also, guys, y'all check out Moomoo. If you sign up to Moomoo, You can get up to, I believe it's up to 15 free stocks. Don't quote me on that. I'm pretty sure it's up to 15 free stocks. Let me check the link that I have here. I'm pretty sure it's up to 15 free stocks. So if you sign up to Moomoo, you get up to 15 free stocks with a deposit of at least $100. And so again, if you want to check out Moomoo, that's a pretty good deal. Up to 15 free stocks, 0 commission, stock and option trades, 24-hour orders. You can put in orders 24/7 on Moomoo, and it's just a better option than like some of the other ones like Robinhood. Again, pushing up a little bit here, so might as well get the free stocks. Great platform. It's very similar to like Webull. SPY just ripped up here. So SPY at 437s right now, 437s. And again, we'll see if it actually holds. Here's the link for that for Moomoo. And yeah, guys, check that out. I appreciate the love and support. And again, guys, we're going to go on over to our crypto show today. Also, guys, you want like the best indicators in the game, check out Chart Prime. Chart Prime. If we look at TradingView here, a lot of the trading I've been doing today is based off of Chart Prime indicators today. So we pull up like the SPY. I use this in futures market too. Again, they show you smart money concepts. It's like $35 a month. You can look at this U-shaped pattern that the SPY is giving us though. Nice little U-shaped pattern. But yeah, you can see the smart money concepts, the support resistance, the equilibrium. It also shows you market oracle where you see potential reversal patterns. Look at the sell signal here and the buy signal here. So it's actually pretty accurate. Look at the strong sell signal here. $35 a month is what this costs. $35 a month. So pretty reasonable, I would say. Again, hit the subscribe button if you haven't already, guys. Hit the notification bell. I'm ending this stream, and as soon as we close this stream, it's going to bring you to our crypto show. We are doing a crypto show today about the SEC versus crypto. Links to all my sponsors are in the description, guys. I appreciate the love and support. Thank you guys so much. We are pretty close to hitting how many subs we got right now? We got 109.4 thousand subs. Hit the subscribe button, guys. We're going to go over to our crypto show today. I appreciate all the love and support, but we are going to go over to our crypto show today. So I will see you guys later. Good luck. And yeah, I'll see you guys over there. Again, as soon as we end the stream, if it doesn't bring you for whatever reason to our crypto show, it's youtube.com/beginnercrypto. I will post this link. I will post this link if for whatever reason it does not bring you there. Here is the link. Check it out. And again, good luck. Love you all. Y'all be good. Again, there's a link right there. It's youtube.com/beginnercrypto, and I will see you guys over there right now. Hey, what's up, Cam?
Jam. How we doing?
So let me end the stream. I don't think